Your retirement fund is betting against your paycheck. Your 401k just helped cut your raise. Here's the receipt. Over half of private equity dollars come from retirement plans, and a growing push aims to channel even more through target date funds. The safe path to retirement is quietly taxing your paycheck. Watch this chain. Your contributions flow into a target date fund, which allocates to a private equity sleeve, which buys your employer's competitor, loads it with debt, and forces cost cuts, meaning freezes, outsourcing, or layoffs in your market. In the next few minutes, you'll learn the mechanism, how to see if your money's in it, and what to do next. Why now? The urgency bridge. If you're feeling squeezed, it's not your imagination. Prices climbed fast, wages barely kept up, and there's no cushion for silent pay cuts baked into the system. Here's the part most people miss. When private equity speeds up during rate cut cycles, the deal machine hunts for predictable capital and quick efficiency plays. Retirement contributions are perfect, automatic, steady, and huge. Inaction means more dollars funnel into strategies that turn labor into the first lever. This clicked for me when I saw how default options do the heavy lifting. Most people never touch their lineup. Target date funds sit on autopilot, and when they add alternative sleeves, private equity, private credit, you're in, unless you actively choose out. Meanwhile, defined benefit pensions already commit to private equity through limited partnership agreements, so the pipe is built. Opening 401k, S-Wider just pushes more water through. The payoff for fixing this is simple. You keep more of your paycheck, and you reduce the odds that your cost of living rises faster than your returns. The three-part framework we'll use is straightforward. Identify your exposure, so you're not guessing. Diagnose the real-world impact risk on your industry, your town, your rent, your healthcare. Then reallocate to options that don't fight your paycheck. Lower fee, transparent, liquid choices that still compound. Why now? Because policy momentum is shifting. There's a live push to democratize access to private assets inside 401ks. Even if it takes years to fully roll out, menus evolve quietly and defaults set the path. The earlier you steer, the more compounding works for you instead of against you. Let's map the money trail first. Follow the dollars from your paycheck to the deals squeezing margins on the other side. The money trail, how your savings reach private equity. Let me show you exactly how the flow works, step by step, so it stops feeling abstract. Start at payroll. A slice of every paycheck lands in your 401k. If you didn't choose, you were defaulted into a target date fund, those one-stop funds that shift from stocks to bonds as you age. Here's the thing most people miss. Many target date funds now include alternative sleeves. That can mean private credit, real estate, or a private equity allocation, sometimes inside a collective investment trust that discloses less than a mutual fund. Now move one layer down. The target date fund is a fund of funds. It allocates pieces to underlying strategies. When an underlying sleeve commits to a private equity fund, it signs a limited partnership agreement. Your fund becomes a limited partner, LP, in a pool run by a general partner, GP, the private equity firm. That commitment isn't a one-time wire. It's a pledge drawn over several years by vintage funds. So even if markets move, the capital calls keep coming. That predictability is gold to dealmakers. Pensions follow a similar path. Their investment committees make multi-year commitments to private equity funds across vintages, buyout, growth, sector-focused. Consultants shape these allocations, and because pensions are long horizon, they're comfortable with illiquidity. The punchline, whether through your 401k default or your state pension, retirement flows are a major LP base behind private equity. Before we get to the wage blade, understand the fee stack, because it explains the pressure. At the top, the target date fund charges a fee. Inside it, the alternative sleeve adds its fee. The private equity fund typically charges a management fee plus performance carry. Then, at the portfolio company level, you have deal fees, monitoring fees, and critically leverage. Debt is a feature, not a bug. Interest payments become a monthly must-hit target. All those fees and debt service must be paid from somewhere. Higher margins, higher prices, asset sales, or lower labor costs. Why does retirement money beat bank loans for private equity? 2 reasons. First, patience. Retirement capital is locked up for decades. Private equity needs a 7 to 10-year runway. Second, predictability. Contributions drip in every pay period, target date funds rebalance automatically, and pensions adhere to policy targets. When the fundraising team says, "We have dry powder," that's often your future contributions already spoken for. Okay, here's where your paycheck meets the blade. A PE fund draws capital from your target date sleeve and buys a company in your industry's value chain. Your employer, a competitor, a key vendor, a landlord, a hospital, or a grocery chain. The deal closes with leverage. Immediately, there's a new line item, interest. To protect returns, management sets margin targets. The fastest adjustable lever? Labor. Hiring freezes, overtime cuts, schedule instability, outsourcing, or outright layoffs. If it's a roll-up, consolidation reduces local employer competition, anchoring wage offers. If it's a landlord or hospital, the pressure shows up as rent increases, higher fees, or shorter staffing, all of which tighten your personal budget. Intermediaries smooth this along. Record keepers present core menus, where target date funds are the default. Consultants recommend managers, sometimes while earning from multiple sides of the table. Prospectuses and fact sheets use vague labels, multi-asset, real assets, opportunistic credit, that make it hard to see the private equity exposure. In pooled vehicles, especially collective trusts, transparency can be thinner than in retail mutual funds. Unless you dig into the statement of additional information or ask your plan administrator for the underlying manager list, you won't see the LP commitments. Let me pause for a quick checkpoint. If you remember nothing else, remember this model. Paycheck to plan, plan to target date to alternative sleeve, sleeve to PE fund, fund to leveraged acquisition, acquisition to labor and price pressure, and the profits, after fees, flow back to your account. You're paying in three pockets: at work through wage pressure, at the register through higher prices, and in your retirement through stacked fees. You might be thinking, but don't private equity deals improve efficiency? Sometimes they do, streamlining operations, modernizing systems, focusing product lines. The problem is the incentive math. With carry tied to beating a return hurdle and a ticking clock to exit, changes skew toward fast, measurable margin moves. Labor is visible and immediate. Long-term investments in training or service quality pay off after the hold period, so they get cut first. There's one more subtlety: liquidity mismatch. Your 401k offers daily pricing, but the private equity sleeve prices infrequently and relies on appraisals or lagged marks. That can mask volatility and make the returns look smooth until they don't. Meanwhile, the debt at portfolio companies isn't theoretical. It's due every month, which keeps the pressure on payroll and pricing. Now that you can see the money trail end to end, we can talk receipts, the specific ways this playbook shows up in healthcare, retail, and housing, and what that means for your wages and your bills. Then we'll open your plan documents together and check whether your dollars are feeding that machine. The cost-cutting playbook, where wages lose. Now here's where most people mess up. They think efficiency means better for everyone. In leveraged deals, efficiency usually means hitting a debt service number fast. The clock starts at closing. Interest and amortization don't care about your onboarding plan or this quarter's training. Cash has to show up. So leadership sets immediate margin targets, and the fastest movable lever is labor. Everything else, product refreshes, systems migrations, renegotiating long-term contracts, takes quarters. Payroll moves today. The first move is almost always a freeze. Hiring freezes, merit raise freezes, travel freezes. Then the quiet reductions. Hours trimmed to dodge benefit thresholds, overtime cut even when demand spikes, schedules juggled so fewer workers cover more ground. If savings don't materialize fast enough, it escalates to layoffs, outsourcing, and offshoring. The thing most people miss is sequencing. Freezes by time to plan a reduction in force while natural attrition lowers headcount without severance. It sounds tidy in a deck, it's messy in your paycheck. Once you nail that pattern, everything else clicks. In roll-ups, where a fund buys several competitors and stitches them together, duplicative roles become synergies. That's code for fewer managers, shared HR and IT, consolidated logistics, and standardized pay bands across the new platform, usually anchored to the lowest acquired scale. Local labor markets lose employer competition, so wage offers drift down or stall. You'll see it in job postings, broader territories, bigger workloads, competitive pay language with no numbers, and generous-sounding titles to mask flat cash. The game changer nobody talks about is vendor squeeze. When the portfolio company is a big buyer, It pushes longer payment terms and lower unit costs onto smaller suppliers. Those suppliers don't have pricing power, so they pass the pressure to their own payroll. Fewer hours, slower raises, reduced benefits. You might not work for a PE-owned company, but your paycheck can still get hit through your employer's squeezed vendors. That's the hidden second-order wage tax. Debt service is the metronome. Say a deal loads a company to 5 or 6 times EBITDA. Even if interest rates tick down, the monthly nut is huge. Management has to produce cash on a schedule. Labor is adjustable, fast, and visible to lenders. Training budgets become nice-to-haves. Safety stock turns into just-in-time, and maintenance stretches longer. Those choices show up as stress on frontline teams. More tasks per shift, tighter quotas, and burnout that drives turnover. Then recruiters claim the labor market requires holding wages flat. Consolidation layers on top. When a roll-up controls a region, switching jobs doesn't escape the pay bands because the same owner sets them. HR calls it internal equity. In practice, it caps offers. Meanwhile, benefit design gets standardized. Higher deductibles, fewer plan choices, narrower networks. If you remember nothing else, remember this. Consolidation cuts your BATNA, your best alternative to a negotiated agreement. Less outside leverage means less inside pay. Let me show you exactly how margin math locks this in. Picture a 10% margin business that just took on debt. Lenders expect coverage ratios. Investors expect carry. To move margin a single point, management can either raise prices or cut costs. Price increases risk volume loss and competitor response. Cutting labor delivers a straight shot to margin. Headcount down 5%, scheduling optimization software up, same output targets. On paper, labor productivity improves. On the floor, you're sprinting. Now you might be thinking, what about genuine productivity, automation, process redesign? Those investments pay off, but they need time and cash. In a 3 to 5 year hold aiming for an exit multiple, short cycle levers win. That's why you see shared services centers, aggressive store rationalization in retail, and revenue cycle transformation in healthcare, fancy language for fewer people doing more. Here's a common mistake, believing that efficiency gains flow to workers. In leveraged structures, the first claimants are lenders, then the GP fee stack, then the LP hurdle. Only after those are met do savings show up for broad-based pay. And because exits are the goal, keeping labor lean helps the sale narrative. Higher EBITDA per head, scalable platform, proven integration. The incentive is to preserve the squeeze through diligence, not relax it before closing. Roll-ups also reshape scheduling. With more locations under one owner, software can pool labor across sites. That sounds flexible. In practice, it fragments hours, making it harder to qualify for benefits or piece together predictable income. People pick up gig work to fill gaps, reducing their bargaining power with the primary employer. It's a quiet feedback loop that suppresses wage growth. Before we continue, you need to understand how leverage magnifies small shocks. A tiny demand dip or supplier hiccup pressures cash, which triggers another cost round. Because debt is fixed, payroll becomes the buffer. That's why wage freezes persist, even when headlines say recovery. The model prioritizes covenant safety over restoring raises. The last piece is culture. After an acquisition, the message shifts to owner's mindset and do more with less. Perks go first, then training, then headcount. Meanwhile, stay bonuses keep key managers through the hold, creating a two-tier pay reality. Frontline workers carry the throughput. The savings feed the investment case. This next part separates beginners from pros, spotting the playbook early. You'll see the signs, new KPIs focused on margin per head, centralized scheduling tools, benefits harmonization, talk of platform acquisitions, and finance-led reviews of every team. When those appear, you can anticipate the wage pressure and plan your moves. And boom, now that you recognize the pattern, the case studies will make immediate sense. Case study cluster, healthcare, retail, housing. Okay, show me the receipts. Let's start with healthcare because the stakes are literally life and death. A Harvard-led study comparing private equity, acquired hospitals to similar peers found something you can't wave away as efficiency. Emergency department deaths rose by about 13% after acquisition, 7 additional deaths per 10,000 visits. Why? The same study documented 18% cuts to ED salary spending, around 16% cuts in ICU staffing spend, and an 11.6% drop in hospital-wide full-time employees. Another analysis flagged spikes in hospital-acquired infections and patient falls after acquisitions. When you cut staff to hit debt service, patients wait longer, clinicians carry heavier loads, and outcomes slip. Now tie that back to your wallet. If you work in healthcare, those staffing reductions are your raises and hours. Harmonized schedules, float pools replacing permanent staff, and overtime caps show up fast. If you don't work in healthcare, you still pay. Thinner staffing means more billing mistakes, longer visits, and higher downstream costs. Bankruptcy blowups like Steward and Prospect show the other edge. Communities lose access when roll-ups buckle under the debt they loaded. The wage pressure hits inside the hospitals, and the cost pressure hits you as a patient and a taxpayer. Shift to retail. You've seen the closures. Leveraged buyouts and roll-ups in retail often read like the same script. Heavy debt, synergies, and then store footprints shrink. Toys R Us is the classic case. Debt-fueled, 700-plus stores gone, 33,000 jobs lost. Across grocery, at least 7 major chains since 2015 ended up in bankruptcy, closing locations and shedding thousands of workers. When private equity takes over, optimization becomes fewer hours, unstable schedules, and compressed pay bands. Those open availability postings? That's labor flexibility for the model, not predictable income for you. Here's the second-order effect. When a dominant chain in your area closes or consolidates, remaining employers set the wage floor. Fewer competitors for labor means your bargaining power falls. Meanwhile, consolidation upstream pushes vendors on price and terms, and the squeeze ripples back to warehouse workers, merchandisers, and logistics staff. Even if you're not in retail, your town absorbs the hit. Dark storefronts, lower foot traffic for small businesses, and service workers chasing fewer shifts. It's not just job counts, it's the quality of jobs left behind. Healthcare and retail are visible. Housing is personal. After the foreclosure wave, private equity pioneered single-family rentals at scale. Today, corporate landlords own hundreds of thousands of houses, with large platforms setting rents and policies from far away. Research tracking PE-heavy zip codes found faster rent growth than metro averages. Think an extra couple percentage points a year compounding. Some metros saw cumulative rent jumps far above 201 baselines where institutional owners concentrated. And big landlords file evictions more aggressively than small local owners in several studies. Why does this matter for your paycheck? Because rent is the biggest line item for most households. If your landlord is part of a roll-up with targets to hit and fee structures tied to cash yield, every late fee, amenity charge, and market reset at renewal looks like value creation. That rent increase can erase a whole year's raise. If your employer faces the same landlord class for commercial leases, their occupancy costs climb too, reinforcing the squeeze on wages. And when corporate owners cluster homes in a neighborhood, they can set anchor prices and move in lockstep through algorithmic pricing tools, turning your town into a spreadsheet. Let me give you a quick composite from subscribers. One nurse watched staffing levels thin after her hospital's acquisition. Shift differentials were trimmed, and floating outside specialty became mandatory. Her spouse worked at a big-box retailer taken private. Hours fluctuated week to week, making childcare a scramble. Their landlord? A corporate SFR operator that raised rent 9% at renewal and added a $35 maintenance portal fee. Same year, their 401k defaulted into a target date fund that added an alternatives sleeve. That's the flywheel in one household. Wages pressured, expenses up, retirement dollars funding the machine. You might be thinking, aren't there counterexamples? Yes, some PE-backed clinics add services and tech. Some retailers modernize supply chains. Some landlords renovate and stabilize. But across these sectors, the common pattern is leverage first, margin targets second, and labor as the shock absorber. When it works on paper, it often hurts in paychecks and bills. Here's a quick win you can do this week. Map your town's exposure. Make a simple list: your hospital, urgent care, main grocers, pharmacies, big retail employers, large apartment complexes, and common single-family landlords. Google each with private equity, acquired by, or portfolio company. Note anything owned by a PE-backed platform or a large corporate landlord. That 5-minute map tells you where wage and price pressure might show up next, and which job offers or leases carry hidden risk. One more layer because it's easy to miss. Consolidation reduces the outside options that give you leverage when you negotiate pay. If two of the big employers in your field share an owner, their pay bands mirror. If most rentals in your price range are owned by a handful of corporate landlords, your rent ceiling rises together. That's why we're about to dig into the rules that let retirement dollars quietly back this trend. And then I'll show you exactly how to check your own exposure in minutes. The legal loopholes and fiduciary blind spots. But why is your money allowed? To do this, it comes down to how the rules are written and how they're read. ERISA sets a high bar for planned fiduciaries. Act solely in the interest of participants, with care, skill, and prudence. Sounds airtight. In practice, it's interpreted narrowly as maximize risk-adjusted returns, not consider whether these returns are financed by cutting your wage or raising your rent. If you were hoping the law would weigh community impact or labor outcomes, it doesn't. Not by default. The thing most people miss is the carve-outs. Private equity managers work hard to avoid becoming ERISA fiduciaries. They use the plan asset framework and the 25% benefit plan investor threshold, or they qualify under exemptions like QPM. Translation: they structure funds so that, even if your plan invests, the GP isn't treated as managing plan assets, and ERISA's strict fiduciary duties don't attach to them. Your plan fiduciary still has duties to you, but the private fund manager can sit outside that line of fire. Now layer in the sophisticated investor's shield. When retirement money shows up through a target date fund or a collective trust, it's pooled. The vehicle itself often qualifies as an accredited or qualified purchaser, and you, the participant, don't see through to the underlying limited partnerships. That pooled status opens doors to private funds with lighter public disclosure. The result is opacity. You're not getting a 10K on portfolio companies. You're getting quarterly letters, appraised valuations, and summary holdings, if that. Disclosure gaps are where accountability dies. Fact sheets may say alternatives allocation or private market sleeve, but they rarely detail which buyout funds, what sectors, or the leverage profile of portfolio companies that touch your wages or bills. Prospectuses point to risks of illiquidity and valuation. Not this fund owns hospitals that cut ED staffing, or this landlord platform files evictions at higher rates. Even pensions, where reporting is better, list commitments by manager and vintage, not labor practices at portfolio companies. Before we continue, you need to understand default options. Defaults aren't neutral, they're policy choices. When a plan selects a target date fund with an ALT sleeve as the qualified default investment alternative, most participants end up exposed automatically. No conspiracy, just inertia. People don't opt out because enrollment packets are dense, HR is busy, and the performance line looks smooth. The hidden step is that smoothness can come from infrequent marks, not lower real-world volatility. Conflicts of interest live in the pipes. Many plan sponsors rely on investment consultants to build menus and recommend managers. Some consultants have business ties to the same asset managers they recommend, or earn fees from platform relationships. Record keepers nudge sponsors toward off-the-shelf core menus dominated by the largest target date families. Those series may add private credit or private equity sleeves as innovation. Then marketing reframes opacity as sophistication. None of this is illegal by itself. It just tilts the table. Policy wins matter. A 202 Department of Labor information letter said, in effect, that it can be prudent for a fiduciary to include a professionally managed asset allocation fund with a private equity component. A later cautionary statement was rescinded, and fresh political momentum now pushes to democratize private assets in 401ks. Even advocates admit it'll take years to implement, but menus evolve incrementally. One basis point fee cut here, one diversifier there, and the default starts wearing an ALTS jacket without most people noticing. Here's the shortcut nobody teaches. Ask where the fiduciary duty stops. Your employer, as plan sponsor, has the ERISA duty to prudently select and monitor investments. The target date manager has a duty under securities law and its own mandate. The private equity GP owes duties to its fund investors under partnership agreements, but typically not ERISA-level duties to you personally. So when wage or rent externalities pop up, there's no line in the documents that says, consider downstream harm to participants' incomes or living costs. That's the blind spot. Common mistake. Assuming lawsuits will clean this up. Litigation can challenge excessive fees or imprudent selection. but proving that specific private fund exposure suppressed your raise or raised your rent. That's a steep evidentiary hill. Meanwhile, the fee stack and leverage cycle keep spinning. Better to control what you can, clarity over your menu, pressure on transparency, and pushing for options that don't tuck private market exposure into a black box. If you remember nothing else from this section, defaults hide choices, pooled structures mute disclosures, and exemptions keep the hardest questions outside ERISA's reach. That's why the next move is on you. Learn to identify exposure, then decide whether you want your retirement dollars doubling back against your paycheck. The Flywheel, returns funded by your cost of living. Let me show you the Flywheel, because once you see it, you can't unsee it. Your retirement dollars help finance leveraged buyouts. Those deals push 3 levers: labor cuts, price hikes, and fees. The profits flow back to your account, but they're funded by pressure on your current wages and higher bills at home. You pay 3 times, at work, at checkout, and in the fee line. Why this works comes down to how pain and gain are distributed. The pain is diffuse, tiny cuts spread across millions of workers and consumers. The gains are concentrated, carry and fees accruing to a small group, plus outperformance, inside your fund that shows up as a smooth line. There's no dashboard where the hidden costs get netted against the reported returns. So the model keeps spinning. Here's the simple mental model I use: the 3-pocket wallet. Pocket 1 is wages, what hits your paycheck. Pocket 2 is expenses, what leaks out through rent, healthcare, groceries, and fees. Pocket 3 is retirement, what compounds in your 401k or pension. The private equity pipeline reaches into all 3. It squeezes Pocket 1 with labor efficiencies. It taps Pocket 2 with consolidated pricing and fee stacks. Then it credits Pocket 3 with returns financed by the first 2. If you remember nothing else, remember the 3 pockets. Let me make this concrete. Say your target date fund has a private market sleeve. That sleeve commits to a buyout fund that acquires a hospital system in your region. Staffing is cut, overtime is restricted, and throughput targets rise. If you work there, your raise gets delayed, and your schedule gets tougher, Pocket 1. As a patient, you face higher facility fees and longer waits, Pocket 2. The hospital's higher cash flow, helped by reduced staffing and higher billing, feeds the fund's IRR, which flows to your retirement account, Pocket 3. You win in the long run by losing today. Now flip sectors. A retail roll-up trims stores, standardizes pay bands, and pushes vendors on terms. You might not work there, but your employer buys from those vendors, who respond by cutting their own payroll and benefits. Local job options shrink, and wage offers converge downward. Meanwhile, the surviving stores can nudge prices up because competition thinned. Again, wages downshift, expenses creep, retirement marks up. Housing is the cleanest example. A corporate landlord raises rent 7% at renewal, adds amenity and processing fees, and tightens late fees. Your mortgage alternative is limited because those owners outbid first-time buyers for entry-level homes. That rent hike eats your raise. The yield looks great in the fund that owns the landlord. Your 401k smiles, your checking account frowns. The reason this flywheel keeps speed is timing. Returns are measured on the fund's clock. Your life runs on the monthly clock. It's easier to see a higher quarterly NAV than to notice your raise was 1% lighter or your rent 2% higher than it would have been. And because illiquid assets report with lagged, smooth valuations, they look calm while the real-world extraction is immediate. Now you might be thinking, isn't compounding still good? Yes, compounding is your friend. But compounding funded by your present-day extraction is a bad trade if the drag on wages and the rise in costs outpace the incremental return after fees. Transparent, low-fee public market exposure compounds without requiring hospitals to understaff or landlords to hike renewal fees in lockstep. That's the key distinction: growth versus extraction. Common mistake: assuming a few basis points in fees don't matter. In stacked structures, those bips multiply. Top-level fund fee, alternative sleeve fee, PE management fee carry, plus portfolio-level transaction and monitoring fees. Meanwhile, debt magnifies the need for cash, which keeps the labor and price screws tight. The fee story and the wage story are 2 sides of the same lever. Microstory: a viewer sent me their numbers. Their target date fund's private market sleeve added 0.35% to the expense ratio. Their rent rose 8% at renewal from a corporate landlord. Their hospital copay jumped after a network change. Their raise? 2%. Their retirement balance looked great on paper. Their monthly surplus shrank to near zero. That's the flywheel, quiet, legal, effective. Here's the aha. Retirement growth can be financed by present-day extraction from the same people it's meant to help. If you stop the extraction on pockets 1 and 2, even a plain index in pocket 3 can win on a life-adjusted basis. That's why the next move matters. How to stop paying 3 times. Let's identify where your account is plugged into this cycle and reroute it toward transparent, liquid, low-fee compounding that doesn't bet against your paycheck. Identify, is your retirement account funding this? Let's find out if your dollars are plugged into this. We'll keep it simple and fast. Start with your plan lineup. Log into your 401k or 403b portal, open investments or fund lineup, and list the names and tickers of every option. You're looking for 4 buckets: target date funds, balanced or multi-asset funds, index funds, and capital preservation options like stable value or money market. If you're in a target date fund, star it. That's the default path where private market sleeves often hide. Open the fund's fact sheet. Scan the description and holdings. Keywords that signal exposure. Alternatives: private markets, opportunistic, private credit, illiquid, limited partnerships, co-investments, secondary investments, and direct real estate. If you see CIT or collective investment trust, know that disclosures can be thinner than mutual funds. Not bad by itself, but it means you'll need to dig one layer deeper. Next, grab the prospectus or offering memorandum. Use the search function for private equity, partnership, LP, drawdown, capital calls, Schedule K1, and valuation. You're not trying to become a lawyer. You just want proof of whether this product can allocate to private funds or owns them already. If it's a target date series, check the glide path components or underlying managers sections. Many large families now include a private market sleeve up to a set percentage. Note any maximum allocation and current allocation if disclosed. Now look at the index funds. Plain vanilla broad market index funds, total U.S. stock, total international, S&P 500, U.S. bond aggregate, generally don't own private equity. If the name includes plus, enhanced, multi-factor, or real assets, open the fact sheet and verify holdings. Your aim is to separate transparent beta from anything with an opaque sleeve. Stable value deserves a check too. Open the fund fact sheet and the wrap provider list. Many stable value funds hold high-quality bonds wrapped by insurers. That's fine, but some use asset-backed structures or private credits. Search for private credit, ABS, CMBS, and wrap termination language. Note any gates or withdrawal restrictions. These are signals that liquidity might not be instant in stress. If you're in a public pension, look up your plan's comprehensive annual financial report, CFR, or annual report on the plan's website. Find the asset allocation and private equity commitments tables. You'll see managers and vintage years. That's your exposure list. For state, university, or municipal plans, investment committee minutes often list new commitments. Copy those manager names. Stuck because your plan uses collective trusts with no tickers? Ask. Email HR or the plan administrator with one sentence. Please provide the underlying managers and asset class breakdowns for each collective trust or target date series in our plan, including any allocations to private equity, private credit, or other illiquid alternatives. They may send a look-through report. Save it. 2 quick pro moves. First, check the expense ratio changes over time. If your target date fund's expense ratio jumped by 0.10, 0.40 percentage points recently, that can be a hint an alternative sleeve was added. Second, scan the quarterly commentary. Phrases like expanded our private markets exposure, closed a commitment to a flagship buyout manager, or harvested co-investments are direct tells. Now connect exposure to your world. Make a short list of private equity firms and real estate platforms you see named fund families, buyout managers, private credit shops, and property operators. Keep it to 5 to 10 names. Then, set basic Google alerts with manager name acquires, manager name portfolio company, and manager name real estate. You're building a passive tripwire, so you see when your retirement dollars back deals touching your industry or town. A common snag is confusing real estate with private equity. Real estate funds can be public REIT index funds, transparent, or private core, value add, or opportunistic vehicles, less transparent. Read the holding types. If you see direct property, appraised valuation, or open-end diversified core, that's private. Note it. One more place to look, the plan's investment policy statement, IPS. Ask HR for it. You want to see whether the IPS allows alternative investments in qualified default investment alternatives and any caps. If the IPS is silent, ask if the committee has considered private markets in the default and what guardrails they use for liquidity, valuation, and fees. For each fund you hold, score exposure with a simple traffic light. Green, pure index mutual funds or CITs tracking broad public benchmarks with no alternatives language. Yellow, balanced or target date funds with alternatives or private markets up to a stated cap, CITs with partial look-through. Red, products that explicitly commit to private equity, private credit, or liquid partnerships or show current allocations there. If you're in multiple target date vintages due to old rollovers, consolidate and reassess. Older vintages in some series adopted alternatives earlier, so your accidental mix could be riskier than you think. If your plan offers a target date index and a target date without index in the name, the index version is usually cleaner. Verify on the fact sheet. Final step, document. Make a one-page log with the date, your current allocations, each fund's expense ratio, and your red, yellow, green rating. Add a notes column with any manager names and maximum alternatives caps. This becomes your baseline before you diagnose real-world risk and decide whether to reallocate. You don't need perfection here, just clarity. Once you know if and where private markets sit in your lineup, you can choose to keep, limit, or exit that exposure. Next, we'll translate those fund names and manager lists into actual risk for your paycheck, your industry, and your local cost of living. Diagnose. What's the real-world impact risk? Now that you know your exposure, let's translate it into actual risk for your paycheck and cost of living. We'll build a simple scorecard you can fill in today. Start with industry overlap. List your employer, its top 3 competitors, your essential vendors, and your landlord or property manager. For each, ask, is it owned by, selling to, or competing against a private equity-backed platform? Quick check, search, company acquired by, company private equity, or company portfolio company. If 2 or more in your immediate work circle connect to private equity, mark industry exposure. High. 1 connection is medium. None is low. This matters because exposure in your value chain is where wage freezes and pricing pressure show up first. Now leverage check. If you can find it in press releases, lender presentations, or business press, note average debt/EBITDA at the portfolio companies tied to your plan's managers or to your employer's roll-up peers. If numbers aren't public, use sector norms from coverage. Many buyouts target 4 to 6 times EBITDA, sometimes higher. Higher leverage means tighter cash demands and faster labor cuts when demand dips. Score leverage pressure. 1 if under 3x, rare in buyouts. 2 for 3, 5x, 3 for 5x plus, and 4 if there's recent refinancing stress or covenant chatter. The higher the score, the more likely your raise becomes the buffer. Next, consolidation risk. Pull a quick HHI proxy. Count the meaningful employers in your metro for your role. If there are 5 or fewer, and 2 share an owner or have an active roll-up buying peers, competition for your labor is thin. Mark consolidation, high. If there are many independent employers and no roll-up activity, low. Medium sits in between. The thing most people miss. Even if you don't work for PE, if your only outside offers due, your bargaining power still drops. Expense pressure is the next leg. List your top 3 household costs: rent or mortgage, healthcare, and groceries. For each, note whether a PE-backed platform is a dominant player in your area. Corporate landlords controlling many rentals, hospital systems owned by financial sponsors, grocery chains that recently restructured under heavy debt. If 2 of 3 are PE-influenced locally, mark expense pressure, high. 1 is medium, 0 is low. Combine that with your wage exposure to see the 2-pocket squeeze. Now add pricing power. This is about whether the companies around you can raise prices without losing customers. Hospitals with limited competition, landlords with clustered ownership, or consolidated retailers typically have more pricing power. Score each sector near you 1 to 3, low, medium, high. High pricing power with high leverage tends to push faster pass-throughs to consumers. That's your checkout wallet. Layer in timing risk. Rate cuts and credit booms are when deal activity picks up. If your alerts show multiple acquisitions in your sector in the last 12 to 18 months, add a timing flag. More recent deals mean integration and synergy. Rounds are likely still underway, which often coincides with hiring freezes and benefit harmonization. Put a note, next 6 to 12 months elevated. Let's pull this into a quick scorecard you can keep. 5 lines. Industry exposure, leverage pressure, consolidation, expense pressure, pricing power. Rate each low, med, high, or 1 to 4 as we discussed. Then 1 line for timing, calm or hot. If you're sitting at 3 highs or a total score of 10 plus, consider your paycheck and bills meaningfully exposed. Now, an example so this clicks. Say you work in outpatient care. Your plan shows a private market sleeve with commitments to healthcare buyout managers. Your local hospital and 2 big clinic chains were acquired within 5 years. Your landlord is a corporate owner. Rent jumped 7% last renewal. Grocery Options are a national chain that emerged from bankruptcy and a discounter that's consolidating. Your scorecard likely reads: industry exposure high, leverage 3, consolidation high, expense pressure high, pricing power medium high, timing hot. That profile says, expect wage pressure and rising costs unless you change either your job market or your portfolio exposure. Common mistakes to avoid. Don't assume diversified private markets equals low risk. If it's diversified across sectors you rely on, healthcare, housing, staples, that can amplify your personal exposure. Don't stop at brand names. Many portfolio companies operate under local banners. Check the portfolio pages on manager sites to match names. And don't treat national headlines as your risk. Your metro's ownership map is what sets your negotiating leverage and your bills. 2 fast diagnostics you can run tonight. 1. Pull job postings for your role across major employers in your metro. If most omit salary ranges or cluster at similar numbers after years of inflation, that's consolidation speaking. 2. Call 3 local property managers posing as a prospective renter and ask about renewal increase policies. If you hear market resets and algorithmic pricing talk, note it under pricing power. Finally, tie this back to your plan. If your scorecard is hot but your allocations run through target date funds with opaque alternative sleeves, your retirement dollars are likely aligned with the very strategies pressuring you. That doesn't mean panic. It means you've diagnosed the mismatch. In the next section, we'll move the money toward transparent, lower-fee options that still compound, while you work the levers at your job and in your town to raise your bargaining power. Reallocate, safer defaults that don't fight your paycheck. Now let's move the money. The goal is simple. Keep compounding, cut opacity, and avoid products that quietly profit from squeezing your wages or hiking your bills. You don't need exotic tricks, just a clean lineup and a few guardrails. Start with plain vanilla index funds. Think total U.S. stock market, S&P 500, total international, and U.S. aggregate bond. These track public benchmarks, disclose holdings daily, and don't tuck private equity or private credit inside. If your plan has 2 target date series, one labeled index and one without, favor the index series. If there's no index series, consider building your own DIY target date with 3 funds: U.S. stock, international stock, and U.S. bond, weighted to your risk. It's transparent, cheap, and liquid. The thing most people miss is that a clean mix beats fancy marketing. A 70/30th stock-bond split using index funds gives you broad growth without the fee stack or valuation lag you get from private market sleeves. As you age, you can tilt more to bonds. You control the glide path instead of outsourcing decisions to a black box. Now bonds. If your plan offers a core bond index fund, use it. If you want more control, some plans let you build a treasury ladder through a brokerage window, short, intermediate, and long treasuries. Inside of 401k, treasuries give you pure interest rate exposure with no credit risk. That's different from private credit funds that reach for yield by lending to the same leveraged companies that cut wages. Stable value versus money market deserves a quick checkpoint. Stable value often pays a higher yield than money markets by holding high-quality bonds wrapped by insurers, but you need to read for gates and wrap providers. Ask for the fund's market-to-book ratio, wrap list, and termination provisions. If the terms are opaque or include private credit, lean to a money market or short-term treasury index. Liquidity and clarity beat a slightly higher stated yield with unknown strings. If your plan has a self-directed brokerage window, treat it like a power tool. Pros: access to low-cost index ETFs, treasury ETFs, and sometimes tips. Cons: analysis paralysis, potential trading costs, and the temptation to buy opaque alt products that sneak back in. Set guardrails: only broad beta ETFs and treasuries, no individual stocks unless part of a small, capped sleeve, and no products with performance fees or K1s. You're building a simple, transparent portfolio, not a hobby shop. Let's talk fees because that's where quiet drag hides. Pull expense ratios for every fund you own. Target under 0.1% for core U.S. equity index, under 0.12 to 0.15% for international, and under 0.1% for U.S. bond aggregate if possible. If your target date index runs 0.08 to 0.15% and the non-index version is 0.40 to 0.70%, that gap often reflects an alternative sleeve and extra layers. Saving 30 to 50 basis points compounds into real money over decades, and you're not paying to be exposed to illiquid bets. Personal preference versus best practice. Here's how I draw the line. Preference is whether you hold one target date index or a 3-fund mix. Best practice is low fees, high transparency, and daily liquidity. Preference is whether you tilt a bit to small caps or value. Best practice is avoiding enhanced or plus strategies you can't explain in one sentence. Preference is whether you keep 6 to 12 months of expenses in cash-like funds inside or outside the plan. Best practice is ensuring your plan allocation doesn't depend on a fund that can gate withdrawals or has appraisal-based pricing. Now, sequence your reallocation. First, stop new contributions to red flag funds. Anything with private equity, private credit, or private markets language. Redirect contributions to your chosen index lineup. Second, exchange existing balances from red flags to your clean options. If there are trading windows or restrictions, set calendar reminders and chip away. Third, confirm your default. If you leave the company, you don't want future auto-rebalancing to push you back into opaque sleeves. A quick example to make this concrete. You're in a 2045 target date fund with a 10% private market sleeve, expense ratio 0.64%. Your plan also offers a target date index at 0.12% and the standard 3 index funds. U.S. total 0.04%, international 0.08%, U.S. bond 0.05%. Option A, switch to the index target date and be done. Instant fee cut and no out sleeve. Option B, build 85% stocks, 15% bonds using the 3-fund mix and set an annual rebalance. Either way, you've removed the mechanism that can bet against your paycheck. What if your only equity options are active funds with middling fees? Pick the lowest cost, broadest option while you work with HR to add index funds. Document your request. Show fee comparisons, index availability from the same record keeper, and how it reduces fiduciary risk. Many sponsors will add a total market index when presented with a clean, low-effort change. Finally, check alignment across accounts. If you have an old 401k, roll it to an IRA with transparent index funds. If your spouse's plan is cleaner, tilt more equity risk there and keep bonds in your plan's best option. The portfolio is a household decision. Remember the goal: keep compounding without funding the squeeze. Transparent beta, simple bonds, and cash-like ballast do that. If your plan menu is a brick wall, don't worry, we'll pull other levers next. If your plan is locked, levers you can pull anyway. What if your menu is a brick wall? No index target date, no brokerage window, and HR moves at glacier speed. You still have levers. The first is contribution routing. Split new money away from the red flag default. If your plan lets you direct contributions by fund, reduce the target date allocation, and increase the plain index options you do have, even if they're not perfect. Small shifts on every paycheck compound. If you're stuck with only 1 or 2 active funds plus the default, push more into the broadest, lowest cost fund while you work longer-term changes. Second, use time to your advantage. Many plans allow exchanges during quarterly windows or limit round tripping. Map the calendar. Stop new money to opaque funds now, then move legacy balances in chunks as rules allow. Set reminders. This isn't about timing markets. It's about exiting opacity on a schedule your plan permits. Third, rollovers. Old 401k's from past jobs are often the easiest wins. Move them into an IRA you control with low-cost, transparent index funds. That instantly cuts your blended fee rate and removes private markets exposure, hiding in legacy defaults. Keep good records and avoid commingling pre- and post-tax amounts without a plan. If your current plan is locked, your IRA can carry the clean core of your family portfolio while you slowly improve the workplace plan. Fourth, adjust risk in the accounts you do control. If your active workplace plan has unavoidable opacity, tilt the IRA toward equities and hold more bonds in the plan's cleanest bond option. Asset location works inside retirement accounts too. You'll still hit your target risk without feeding the opaque sleeve more than necessary. Fifth, automatic escalations. If your plan auto-escalates your contribution rate, keep it on, but redirect the escalated portion into the cleanest funds on the menu. If that's not possible at the contribution level, set a quarterly exchange rule of thumb. Every time your contribution rate rises, shift an equal percentage of the cumulative balance out of the opaque default. Now, HR advocacy. You don't need to be confrontational. Ask for a lineup review and bring a one-page brief. Current fund expense ratios, availability of equivalent index options from the same record keeper, and a simple fiduciary angle, lower fees, higher transparency, daily liquidity. Propose concrete additions: total U.S. stock index, total international index, U.S. aggregate bond index, and a target date index series. Offer sample tickers or CIT equivalents the record keeper already supports. The easier you make the change, the faster it happens. Coalitions matter. Find 2 to 5 coworkers who care, especially anyone on the benefits committee or with HR influence. If you have a union, bring this as a cost of benefit issue. Lower fees are a guaranteed raise inside the plan. Share a short exposure scorecard and a template email. Momentum comes from multiple voices asking for the same simple fixes. If you're in a public plan, you have more sunlight. Attend board or investment committee meetings, even virtually. Submit comments requesting an annual look-through report on private markets exposure, fee schedules, and sector concentration, plus a statement on labor and pricing practices at portfolio companies where feasible. Ask for caps on a liquid exposure in default options and plain vanilla index choices for participants. Set tripwires. Create Google alerts for your plan's target date manager. The words adds private markets, private credit sleeve, and collective investment trust update. You'll catch changes before the glossy brochure arrives. When you see a shift, recheck your allocation and adjust your contribution routing. Control spillover risk. If your health plan offers an HSA, treat it like a stealth IRA with transparent index funds if the HSA provider allows it. If it doesn't, keep the HSA in cash and invest an equivalent amount in your IRA. The point is to grow the clean pool you control while minimizing exposure to opaque structures elsewhere. Finally, build a simple paper trail. Document your requests to HR, your allocation changes, and your reasons: transparency, liquidity, fees, and alignment with participant interests. If leadership worries about fiduciary risk, your memo helps. If they don't move, you still win. Your household portfolio got cleaner, your old accounts rolled to clarity, and your contribution flow stopped feeding the machine by default. Negotiate your paycheck with information power. This next part separates beginners from pros. You're going to turn your exposure map into leverage at the table. The goal isn't drama. It's to align your pay with the real risk you carry when your industry or local market is under private equity pressure. Start with salary talks. You're not pleading, you're pricing risk. Use a calm risk offset frame. Try this. Given consolidation in our market and the increased workload from recent acquisitions, I'm targeting $X to reflect execution risk and retention stability over the next 12 months. Then anchor with specifics. In our metro, 3 major employers are under new financial sponsors. That typically means headcount pressure and expanded scopes. I've already absorbed A, B, and C responsibilities. To keep performance high, I need the comp to match the scope. You're naming the elephant without turning it into a rant. Now preempt the deflection. If they say, budgets are tight, reply. That's exactly why retention costs less than rehiring. If we can't meet the base, let's talk levered alternatives, retention bonus, guaranteed variable in writing, and a 6-month review with a defined bump if KPIs are met. Pros bring options. Put it in an email summary after the meeting so it's on paper. Before you ask, do a quick calibration. Pull 3 pay ranges: your company's posted ranges, a competitor's range, and a market data point from a reputable survey or state disclosure. If ranges cluster, push the top and ask for mid-year review terms. If your firm lags, trade scope for pay. I'll lead the integration initiative that consolidates the 2 platforms. My ask is $X and a defined bonus tied to milestones. You're selling business outcomes, not just effort. Your exposure data helps you say no. If your scorecard showed high consolidation and high leverage, your outside options are limited, so you need stronger internal protections. Ask for written role scope limits, cap on weekend surge shifts, cross-training credit, and a retention trigger if headcount drops on your team. If they won't put it in writing, assume it won't happen. Now the job switch filter. When recruiters call, your first questions are ownership and runway. Is the company PE-owned? What's the hold period timing? Any current integration or synergy targets? If yes, dig. What are the headcount plans over the next 18 months? Where are they on debt refinancing? No need to grill, just signal you understand the cycle. Red flags, vague answers on staffing, heavy do more with less, or fast-paced environment with no pay transparency. Prefer employers with cleaner cap tables or demonstrated investment in talent post-acquisition. Local spending choices are your daily veto. You won't always have a perfect alternative, but you can nudge. If there's a non-PE grocer or clinic with fair prices, shift some spend there. If your lease is up, compare corporate landlords versus local managers on renewal policies and fees. Ask directly about increases, add-on fees, and responsiveness. A 2% lower rent increase beats chasing an extra 0.2% in your 401k. Side income is your shock absorber. A small, predictable income stream. Tutoring, specialized freelancing, weekend clinics, maintenance gigs. Reduces your dependence on a single employer's pay band. Treat it like insurance. Set guardrails. 1 client to start, recurring work only, and a cap on hours so it doesn't burn you out. The confidence shift alone helps you negotiate better. Here's the shortcut. Build alerts once and let them work. Set Google alerts for your employer, top competitors, and the PE managers on your exposure list plus keywords. Acquires, portfolio company, layoffs, debt refinancing, restructuring. Add your metro with merger and platform acquisition. When an alert hits, you're the first to understand the direction of travel. In 1:1s, ask targeted questions. I saw the regional roll-up closed. How will scope and staffing change here? What success metrics will matter this quarter? You're surfacing workload changes before they blindside you. Use timing to your advantage. The best renegotiation window is when you deliver a measurable win tied to the consolidation pressure. Stabilizing a location, clearing a backlog, onboarding a new system. Package it. Outcome, metrics, and what you need to sustain it. We cut processing time 22% during integration. To keep that pace, I need $X in base and protected time for systems training. Put the number first, back it with results. If leadership won't move, hedge inside the role. Ask for training budget, certifications, or projects that raise your market value. Career capital beats chasing shaky alpha. Pick skills that travel. Automation tools, data literacy for your function, vendor management, and negotiation. Document these wins publicly inside the company. Internal posts or brown bag sessions, so your value is visible beyond one manager. Finally, widen your option set. Join a local professional group, show up to meetups quarterly, and keep 3 warm conversations going at any time. Your best leverage is credible outside interest, not threats. When you have a real offer, present it respectfully with the risk offset frame. I like this team and work. Here's the external offer at $X with Y-Scope. If we can match the comp and scope commitments, I'd prefer to stay. Calm, specific, and easy to approve. Fast-tracking your research workflow. Let me show you exactly how to cut the grunt work so you can monitor this in minutes, not hours. Start with Google Alerts. Create 1 alert per key manager you saw in your exposure log, plus your employer and top 2 competitors. Use this pattern, manager name, and acquires or acquisition or portfolio company, or refinancing or layoffs. Add your metro for local relevance when it matters. Manager name and city name. Set alerts to at most once a day. deliver to a dedicated Gmail label called exposure. Now the news comes to you instead of you hunting it. Add sector tripwires. Make one alert for private equity healthcare staffing, one for private equity grocery bankruptcy, and one for corporate landlord rent increase, each with your state's name. You'll catch moves that hit wages and costs where you live. If your plan mentions private credit, add an alert for private credit refinancing, plus your industry. Refinancings often precede headcount pressure. Next, pull the official documents once, file them well, and relax. For your plan, download the fund fact sheets, the prospectus or CIT summary, and, if you can get it, the investment policy statement. For pensions, grab the CAFR and the most recent investment committee minutes. Name files with YYYYMM and a clear tag, like 2025 to 2003 target date fact sheet.pdf. Store them in a simple folder called 401k look-through. Once a year, scrape the plan menu. Open your portal, copy the fund list into a spreadsheet, paste expense ratios, and tag each fund green, yellow, red using the traffic lights you set earlier. Add a column for alternatives language Y/N and one for manager names found. Date stamp the sheet. That's your annual X-ray. For SEC materials, use advisorinfo.sec.gov to look up your target date managers, Form ADV, and private fund brochure. You're scanning for private markets or collective investment trust disclosures. If your plan uses mutual funds, Edgar can give you the statement of additional information. Search for investment in illiquid securities and valuation. Save links, not PDFs, so you always land on the latest version. Now build the IDR mnemonic into a single page. Identify, diagnose, reallocate. Top third, your current funds, expense ratios, and traffic lights. Middle third, your local exposure scorecard. Industry exposure, leverage, consolidation, expense pressure, pricing power, with simple low, med, high boxes you can update. Bottom third, your action list, contribution routing, exchanges to execute, HR request status, and alert keywords. Print it or keep it as a pin note. This becomes your compass. Timebox the workflow. Month 1, a 30-minute setup to create alerts, download docs, and fill the one page. Quarterly, 10 minutes to skim alerts and update the scorecard. Annually, 20 minutes to scrape the menu, check fees, and reconfirm your allocation. If anything in your alerts says adds private market sleeve or requires hospital/grocer/landlord in your metro, schedule a 15-minute portfolio check that week. Common mistakes to dodge. Don't chase massive data. You don't need every portfolio company. You need the few that touch your job and bills. Don't bookmark vendor marketing pages. Bookmark filings and plan documents. Don't set as it happens alerts, that's noise. Daily is enough. And don't let the perfect tracker delay a simple fix. Rerouting contributions out of a red fund beats a pristine spreadsheet you never use. Microstory, a subscriber followed this exact setup. They created 5 alerts, scraped their plan, switched from a target date with a private market sleeve to the index series, and rolled an old 401k to an IRA, all in 2 weeks. Their blended expense ratio dropped 38 basis points, and their exposure to private credit and buyouts fell to near zero. The kicker? An alert 2 months later flagged a local hospital acquisition by a manager their old fund used. They'd already moved. One last efficiency tip. Keep a plain text template email to HR asking for a look-through report and index additions. When a coworker complains about fees or performance, share your one-page plus that template. 2 more voices can flip a lineup review from someday to agenda item. You've now got a lightweight system that runs in the background. Alerts surface the risks, your one page keeps decisions clear, and your allocation stays aligned. Next, let's address the big worry. Are you giving up returns by skipping private equity, or does transparent compounding win without the extraction? Returns reality check, performance without extraction. Now the big question, are you giving up returns by skipping private equity, or does clean compounding win? Let's ground this in how retirement money actually grows for most people. Broad equity and bond exposure, low fees, time in the market, and consistent contributions. That engine doesn't need opacity to run. Why transparent beta beats the hunt for smart strategies comes down to math and behavior. Index funds give you market returns minus tiny costs. Alternatives promise alpha after large layered fees, plus appraisal-based smoothing that looks calm until it doesn't. If you remember nothing else, remember this. A predictable 1% fee gap, compounded over decades, erases most alpha stories that don't consistently outperform by more than that gap. Most don't, net of all layers. Sequence risk and liquidity matter more than the glossy IRR in a pitch deck. Your retirement withdrawals will happen in real time, not on a private fund schedule. Illiquid assets can look stable because they're priced infrequently, but their underlying businesses still cycle. When markets break or refinancing costs jump, private vehicles can gate, delay cash flows, or sell at a discount. Public bonds and stocks can drop too, but they're liquid. You can rebalance, harvest losses, and stick to a plan. With private funds, you wait. The thing most people miss is hidden volatility. Many private vehicles show smooth marks until the exit, when the valuation gap meets the bid. That's not lower risk, it's lower visibility. Meanwhile, the leverage inside portfolio companies amplifies outcomes. In good times, that leverage boosts returns. In tight times, it forces layoffs, price hikes, or fire sales. That's exactly the extraction you're trying to avoid funding. So what's the performance alternative? A long-horizon mix, say, global equities paired with high-quality bonds, has historically compounded well without complexity. Add an emergency buffer outside the plan, and your behavior improves. You're less likely to panic sell. Layer in a simple glide path. Reduce equity gradually as you approach retirement, and you manage sequence risk directly. No side bets needed. Here's the shortcut nobody teaches. Your career capital is a bigger lever than fund alpha. A single well-timed raise, skill stack, or job switch can add tens of thousands to lifetime earnings. That dwarfs the incremental return from an alternative sleeve, especially after fees. Spend more energy on negotiation, certifications, and roll leverage, and let your portfolio quietly compound in low-cost indexes. It's boring. It works. Let me show you exactly how to translate this into a portfolio you can live with. If you're more than 20 years out, a 70 to 90% equity mix across total US and total international, with the balance in a broad US bond index, is plenty. Auto-contribute. Auto-increase 1 to 2% a year until it pinches and rebalance annually. If you're 10 to 20 years out, slide equities down 10 to 20 percentage points. Inside 5 years, build a bond/treasury ladder and cash buffer to cover 2 to 3 years of withdrawals. That's sequence protection without illiquidity. Common mistake: chasing uncorrelated returns and underestimating the fee stack. Alternatives diversification benefit can be real in institutional portfolios with full look-through and governance. In most 401(k)s, you're not getting that control or clarity. You're buying a story you can't easily monitor, with an exit you don't control. A clean beta mix plus treasuries does the risk-balancing job with fewer surprises. Quick win you can do today: raise your savings rate 1 to 2%. For many viewers, that single tweak beats most alpha hunts over a career. Pair it with a fee cut by switching to index versions of your current funds, and you've compounded 2 edges. More fuel going in, less friction coming out. That's how you improve expected outcomes without betting on opaque engines. Now, you might be thinking, what about real estate or private credit for yield? Public REIT index funds already give diversified real estate exposure with daily liquidity. For yield, high-quality bond indexes and treasuries avoid lending to the same leveraged companies that create wage pressure. If you really want inflation protection, add a TIPS fund sleeve. Simple, transparent, and aligned with your paycheck. The reason this approach works is alignment. You're not relying on extraction from your own wage and cost of living to make the numbers pencil. You're capturing broad economic growth, minimizing costs, and keeping flexibility. That flexibility is what saves real retirements. You can rebalance, cut risk when needed, and avoid forced errors. So no, you don't need private equity in your 401(k) to reach your goals. You need low-cost, transparent funds, a higher savings rate, and a plan you can follow when headlines get loud. Up next, we'll turn this into a 30-day action plan so you can implement it without overwhelm. Your 30-day action plan. Let's turn this into a simple, doable month. You'll make measurable progress each week without drowning in documents. Day 1 to 3, gather and list. Log into your plan, download every fund fact sheet, prospectus or CIT summary, and your plan's investment policy statement if available. Copy your current allocations, tickers, and expense ratios into a one-page sheet. Tag each fund green, yellow, red using our transparency traffic lights. If you're in a public pension, pull the latest CFR and copy the private equity commitments list. Save everything in a folder named 401k Look Through YYYYMM. Day 4 to 10, classify and score. For each fund, search for the tell words: private markets, private equity, private credit, illiquid, limited partnership, drawdown. Confirm which target date series, if any, embeds an alternative sleeve and its maximum cap. Build your 5-line local exposure scorecard. Industry exposure, leverage pressure, consolidation, expense pressure, pricing power. Rate each low, med, high based on the quick checks you just learned. If your plan's expense ratios jumped recently, note the basis point change and likely cause. Day 11 to 15, pick replacements. Choose a clean core from what your plan actually offers. Target date index if it exists, otherwise a 3-fund mix: U.S. total stock, total international, U.S. aggregate bond. Set target weights that match your risk window. If stable value is attractive, verify wrap terms and gates. Otherwise, prefer a money market or short-term treasury index for cash-like needs. Decide your contribution routing so new money bypasses red funds starting next paycheck. Day 16 to 20, execute reallocations. Stop contributions to red funds, redirect to your clean lineup, and schedule exchanges of existing balances. If your plan has trading windows or round-trip rules, split moves into 2 or 3 tranches across allowed dates. Set calendar reminders so this finishes within 30 days. If you have old 401k, initiate a direct rollover to an IRA with low-cost index funds. Keep pre-tax and Roth dollars separate, and wait to invest until the transfer lands. Day 21 to 24, set alerts and automations. Create Google Alerts for your plan's target date manager, the private markets terms you found, and the top 5 to 10 manager names from your look-through. Add your employer and metro with acquires, refinancing, and layoffs. Timebox alerts to daily. In your spreadsheet, add a quarterly check column and set a recurring 15-minute reminder to skim alerts and update your scorecard. Day 25 to 27, HR outreach and coalition. Send a short, calm email to HR or the plan committee. Request a look-through report for each CIT or target date series. Ask whether the default option includes private markets, and propose adding total market index funds and a target date index. Attach a one-pager comparing current expense ratios versus index alternatives available on your record keeper's platform. Loop in 2 coworkers who care, especially anyone on benefits or finance. Day 28, household alignment. Coordinate with your spouse or partner's accounts. If their plan is cleaner, tilt more equity risk there and hold bonds in your plan's best option. Align HSAs and IRAs toward the same transparent core. Make sure both of you know the contribution routing and rebalancing plan. Day 29, document your baseline. Print or save a 1-page snapshot. Current allocation, expense ratios, traffic lights, your 5-factor exposure scores, and the actions you completed. Add your next review date, quarterly skim, annual menu scrape, and the month to revisit your glide path. Day 30, quick win and next date. Increase your savings rate by 1% if you can. That single move compounds more than most alpha hunts. Then close the loop. Confirm contribution changes took effect, exchanges are queued, rollovers are in motion, alerts are live, and HR has your request. Checkpoint summary. 1 page, 3 numbers, 1 date. The 3 numbers are your blended expense ratio, your equity percentage, and your exposure score total. The date is your next review. You just moved from unaware to in control. Now your retirement can grow without quietly betting against your paycheck. Common mistakes and how to avoid them. Mistake 1, mistaking diversified for transparent. A pie chart with lots of slices doesn't tell you what's inside those slices. Fix, prioritize look-through, not labels. If a fund can't plainly list underlying asset classes and liquidity terms, treat it as yellow or red until proved green. Mistake 2, chasing uncorrelated returns without reading the fee stack. Low correlation sounds great, but stacked fees and carry can eat the edge. Fix, quantify total costs. Add top-level expense ratio, any sleeve fee, estimated PE fees, and portfolio-level charges. If you can't estimate total drag within 0.25%, it's too opaque for default dollars. Mistake 3, ignoring stable value wrap risks. And gates. Many assume stable value equals cash with yield. It's not. Wrap providers, termination clauses, and market-to-book ratios matter. Fix. Ask for the wrap list, termination provisions, and current market-to-book. If wraps are concentrated with one insurer or gates are broad, consider short-term treasuries or a money market instead. Mistake 4. Believing appraisal-based stability equals lower risk. Smooth lines come from lagged marks, not magic. Fix. Remember liquidity hierarchy. You want assets you can rebalance in stress. If a fund's unit price relies on quarterly appraisals or capital calls, assume timing risk and size the position accordingly, or skip it. Mistake 5. Letting perfect be the enemy of done. People stall waiting for the ideal menu or a heroic HR fix. Meanwhile, paychecks keep feeding an opaque default. Fix. Move what you can now. Redirect contributions to the cleanest options today, calendar the rest, and roll old accounts first. Progress beats purity. Mistake 6. Forgetting your local labor market is part of your portfolio. You manage tickers but ignore the employer map that sets your raise. Fix. Keep the 5-factor exposure scorecard current. Industry exposure, leverage, consolidation, expense pressure, pricing power, and revisit it quarterly. If it heats up, tighten household expenses, strengthen outside options, and keep retirement allocations transparent. Mistake 7. Assuming lawsuits or regulators will bail you out. Excessive fee cases can help, but they won't unwind your personal exposure. Fix. Own your defaults. Confirm the QDIA, request look-through reports, and favor index versions of target date series. Mistake 8. Confusing private real estate with public REITs. One is appraisal-based and can gate, the other trades daily. Fix. If you want real estate exposure, a broad REIT index in a brokerage window is clearer than an open-end core property fund in a CAE. Mistake 9. Overusing the brokerage window. It's a power tool that can cut you. Fix. Pre-commit rules, broad beta only, no K1S, no performance fees, and a maximum number of positions. Automate contributions and rebalance annually. Mistake 10. Not documenting. You'll forget why you chose a fund when marketing shifts. Fix. Keep the one-page IDR sheet updated with allocations, fees, traffic lights, and your next review date. Future you will thank you. If you remember nothing else, transparency, liquidity, and low fees first. Move money with a calendar, not vibes, and keep your local exposure map on the same page as your portfolio. Your retirement grows best when it's transparent, low fee, and liquid, so it doesn't quietly profit from squeezing your wages and hiking your bills. Want my exposure scorecard, traffic light template, and a ready-to-send HR request email? Grab the link in the description. For the advanced playbook on spotting consolidation before it hits your paycheck, watch the next video and subscribe.